It was a wild, bold and exotic relationship while it lasted. But Wall Street and China have broken up. Now the US stock exchange risks running massive losses, so it is looking for new partners and it is turning its eyes to the Indo-Pacific. It is almost as if the Wall Street wants to get back at China. It wants to teach the CCP a lesson and it has found the perfect formula to do so. Hi and welcome to TFI Global, the foreign affairs and geopolitical analysis arm of the TFI Media Group. I'm your host Atul Mishra. In this video, I will tell you how China's IPO failure is a golden opportunity for India, Vietnam and Indonesia. Let's begin. The romance between China and Wall Street is coming to an end. It has been a very expensive romance worth trillions of dollars. The breakup will have economic ramifications for both China and the US, since Wall Street was so deeply and madly in love with Chinese companies and the CCP. Leading the crusade to decouple from Wall Street is Didi, a $39 billion company that is China's answer to Uber. Early this month, Didi decided to delist from the NYSE, a move that is designed to earn the goodwill of the CCP. Similarly, Chinese IPOs in the US are about to sink, which is why US stock exchanges are now turning to Southeast Asia and India. According to the Financial Times, US stock exchanges are pursuing listings from companies in Southeast Asia and India to counteract a sudden slowdown in business from China. For a long time, companies from India and Southeast Asia have been nearly absent from US stock exchanges. But that is about to change now, as Xi Jinping destroys one Chinese IPO after the other with his market illiteracy-driven crackdowns. Tensions between China and the US have pretty much dried up listings of Chinese companies on American stock exchanges. Those that do get listed face the wrath of the CCP in more ways than one. This has proven to be a killer for the NYSE and NASDAQ stock market. And to compensate for the shortfall, the US is turning to India and Southeast Asian countries. Bob McCoy, NASDAQ's Asia Pacific chair, told Financial Times, "We think the entire region is ripe for IPO activity. The pipeline has grown from a handful of companies, if you asked me a year ago, into a few dozen today." He added that over the time, a region could become as big a source of business as China was until recently. Insurance group FWD became the latest company to put an end to its flotation plans at the US stock exchanges, fearing reprisal by the Chinese Communist Party. Alex Ibrahim, the NYSE's head of international capital markets, said exchange officials had been spending a lot of time focused in Southeast Asia, more so than in previous years, and I think this will continue. The US stock exchange executives view India and Indonesia as the biggest areas of opportunity because of their large populations and growth potential. Although, as per Financial Times, executives are also expecting an uptick in listings from countries including Vietnam and Malaysia. Indonesia, meanwhile, has relaxed rules for new listings as the country aims to attract more companies seeking to go public. The Indonesian stock exchange's decision to do so comes in the heels of Western bourses eyeing Southern Asian businesses for overseas listings. By foraying into the US, Indian and Southeast Asian companies will be able to raise tremendous capital and challenge China in multiple ways. The fall of China has become public knowledge now. Xi Jinping's anti-market policies have ended up pulverizing the fortunes of big Chinese companies. At China's cost, India and other countries of the Indo-Pacific are set to achieve staggering growth in business. Delhi-based software company Coforge, already listed in India, has filed for a public offering in New York, expected to take place early next year. India's mighty edutech startup Byju's is reportedly in talks to combine with a US-listed Special Purpose Acquisition Company, or SPAC. In September this year, Freshworks Inc., which is a software as a service or SaaS company, became the first of its kind Indian SaaS company to get listed on the US stock exchange. It raised $1.03 billion from its IPO. The company issued its share at $36 per share. It registered a growth of over 32% on the very first day and was trading at $47.55 per share at the end of the day. India is fast emerging as a leader in the SaaS sector. For India, the success of its IT sector has been a story to tell around the world. Now, the SaaS sector promises to outgrow the IT sector itself, and the effects of the same on the Indian economy will be tremendous. According to a report by Forbes, between 2025 and 2030, the software product companies from India will surpass the IT services sector by market value. The market value of India's cloud software companies could touch as much as $1.8 trillion by 2030 if they grow aggressively. India's SaaS companies will lead the way when it comes to listings in the US. Together, India and ASEAN countries will deliver a final fatal blow to China at a time when it is already down and seething in pain.